Let's face it, we all want to be millionaires one day. But what's the best way to make sure that happens? Well, it's to invest and to make your money work for you. And it's easier to get started investing now than it ever has been before. Anyone with as little as $10 can get started investing in pretty much any company they're interested in. And although investing is not nearly as hard as many people might think it is, here are a few rookie mistakes that you should avoid at all costs. So if you're interested in learning how to not lose money and to make sure that you will be a millionaire one day, make sure to stay tuned and watch until the end. Hey everyone, my name is Chris and welcome back to the Lifestyle Design Show, the #1 place for young adults to learn about personal finance and entrepreneurship. And today, I want to share with you some of the investing mistakes that newcomers often make. I started investing at the age of 19, and I know that I made a lot of these mistakes myself, and I lost hundreds of dollars, and even more if you count the opportunity cost of the stocks and investments that I could have made. So let's just jump right into it. Really quick, I want to give a brief disclaimer that I am not a financial advisor. This is not financial advice. I'm just a 21-year-old college student who's excited to share some of the lessons that I've had to learn the hard way and that I wish I knew when I was first getting started. Investing mistake #1 is trying to swing trade or day trade. This is one of the hardest types of investing, and it's literally the first thing that most newcomers start with. Swing trading is when you own a stock for more than one day and then you try to sell it for a higher price than you bought it for. Day trading is the same concept, except you buy a stock and you sell a stock within the same day. Listen, it's nearly impossible to know what a stock is going to do in the short term, and that's something that we're going to repeat over and over. In the short term, it's really hard to predict if the stock is going to go up, if it's going to go down. Now, yes, there are some people who are able to find success with this strategy, and those people are keeping a close eye on the news, on earnings reports, etc. But for the most part, swing trading and day trading is extremely risky. There's a high chance of losing money. I know for myself, I started with this strategy too because it seemed like a cool side hustle. But I ended up losing hundreds and hundreds of dollars and only had a few successful trades that only made me like 10 or 20 bucks. So swing trading and day trading is definitely not the best place for newcomers to start, and even for experienced investors, it's still not the best strategy. It's because any gains that you make are subject to short-term capital gains tax, as compared to if you buy and hold a stock for more than 1 year. Any gains that you make on that long-term investment are going to be considered long-term capital gains, and the tax rate is lower at around 15%. Simply buy and hold your positions. That is a significantly better strategy that has been time-tested and proven over and over. The second mistake is buying into the hype. This happens to a lot of new investors. They hear their friends talking about a stock or the news mention a company, and then they want to get a piece of the pie. And when you buy into the hype, at that point, it's usually at the very top. It's at a very overvalued price, and likely it's gonna come back down and you're gonna lose money. This happened to me in 2019 when I invested into Aurora, ticker symbol ACB. I invested around $300, and unfortunately that stock lost 95% of its value, and I lost all of my money. So if this happens to you and you buy into the hype in an investment that turns out to be not very good, you have two options. You can either research the company, look into the fundamentals, and try to decide if there's any upside, if the company will ever rise again and see previous highs. And if that's the case, you can hold on to the stock, or you can make the decision to sell out. You don't want to be holding a stock that's underperforming year after year after year. Even if you had significant losses, sometimes it's better to just sell out of that losing position and move whatever money is left somewhere else. There is actually one exception of where you should buy into the hype, and that's investing in the like button. In all seriousness, guys, it really helps the channel and it means a lot to me, so I really appreciate it. The third mistake is trying to time the market. There's a quote by Warren Buffett that I think about all the time. He says, "Time in the market beats timing the market. Essentially, what that quote is saying is that being invested in the market is gonna be better in the long run than waiting for a dip or waiting for a discount in stock prices. I know for myself, when I started investing in 2018, there was a lot of companies that I wanted to buy, but I held off because in my head, I was thinking,
I'll wait until the next recession.
But the problem with that mindset is you miss out on a lot of potential gains. If I invested in Tesla, Apple, or Microsoft, or many other companies in 2018, my portfolio would be in a completely different place today. So rather than trying to time the market, which like I said earlier, is near impossible, the better way to invest is to dollar cost average. You invest every week or every month. So you're buying the ups and you're buying the downs. So if the market is going through a dip, you're averaging down. Or if the market is on the incline, you're averaging up and you're earning as you go. Dollar cost averaging is significantly more profitable in the long term than it is to hold your money in cash and just wait for that perfect opportunity. Because a lot of times, those perfect opportunities don't always present themselves. Now, buying the dips is a great strategy when there is a dip in the market or there is a recession or a company gets bad news, but it's a really solid company and the stock price goes way down. Of course, by all means, try to invest in those times because you're gonna get a better average price. But the key here is to just keep investing during the good times and during the bad times so that you'll reap rewards consistently over the long run. Here's the thing, the stock market historically has always gone up. Since 1928, the S&P 500, which is an index fund of the top 500 US companies, has averaged a 7% return every single year. So if you invest $100 in the next year, that $100 historically will turn into $107. And the next year, that $107 will turn to $114.50. Just get yourself invested in the market, even if you're only investing a little bit every week or a little bit every month. The way that I make sure I'm doing this is by turning on automatic investments on Robinhood or Acorns, because it automatically pulls money from my bank account and puts it into the stock market. So whether it's investing into a broad index fund or it's investing into specific stocks, I'm making sure that I am dollar cost averaging every single month so that I can make sure I'm getting the best price over time for these companies. Because think about it, in 5 years, in 10 years, in 20 years, Tesla and Apple stock price today will still be significantly cheaper than they are in the future. So just get in the market and dollar cost average. Don't wait for that perfect opportunity. If you're interested in seeing a full portfolio breakdown and how I've been able to make about 30% return each year, let me know in the comments. I'd love to share. The fourth mistake is listening to the wrong people. I know I did this myself. I followed a lot of stock market Instagram pages because I wanted to learn more. But the problem is these Instagram pages were all Tesla bears. They said the stock was overvalued. They said Tesla was never going to be a good investment. So I didn't invest, even though I really wanted to. And mind you, this was in 2018 and 2019, when the stock price before the split around $200. I did do one swing trade where I bought the stock at like 250 and sold it a week later at like 265. So I made like a $10 or $15 profit. Now looking back, I beat myself up for listening to those people because they were dead wrong. The Tesla share price now, at the time of filming this video, has gone parabolic. I could have made thousands and thousands of dollars if I simply would have listened to my own intuition. So my advice, don't listen to one person and don't listen to the wrong mentors. Do research for yourself. Look into these companies. Look into the fundamentals, the moving average. Look at the 50-day moving average, the 100-day moving average. Look into the news for the company. See if they are innovating. See if the company has a dividend, if that's what you're interested in. I know I love dividends. But seriously, don't listen to the wrong mentors and try to make decisions for yourself, because at the end of the day, These are your investments. This is your portfolio. You want to be investing in companies that you personally believe in. And the fifth mistake is not diversifying enough. And this one hurts. For me, I made this mistake in 2019 when I invested a large portion of my portfolio into Royal Caribbean stock. Now, this was before the pandemic, and there was no way of knowing what was coming in the next year. But this stock has been one of my most significant losses. Right now, I'm losing close to $500 altogether, and it's simply because I didn't diversify enough. So the best thing you could do when you're just getting started is to invest your money in either index funds like the S&P 500, or QQQ is another good one that tracks mostly tech stocks, and personally I think tech stocks are the future. Or if you're gonna do individual stock picks, it's really important to have a portfolio with multiple different companies that are in multiple different sectors. What I mean by this is, instead of me investing $1,000 into one stock, Royal Caribbean, I could have invested $200 into McDonald's, let's just say, $200 into medical technology like AbbVie, that's another one of my favorite stocks, $200 into AT&T, that has a really solid dividend, $200 into Tesla, because that's a solid growth play, $200 into Apple. Spreading out your money and diversifying, you're going to significantly reduce the risk that you're exposing yourself to. By investing in a single company rather than a basket of multiple companies, you're exposing yourself to a lot of upside. The company could do amazing, but there's also a lot of potential downside. A company could go bankrupt or have a couple quarters of bad earnings. So diversification is really important, and learn from my mistake. You don't want to over-invest into one single company. And as a thank you for sticking with me until the end, I have a bonus, and that's not first investing in a Roth IRA or an emergency fund. Let's start with a Roth IRA. What that is, it's a retirement account. It's basically the same as an investment account that you would have on Robinhood or Webull, but it's tax advantage, meaning that at the time that you take out the money at 59 and a half, everything that you've made is completely tax-free. Something that a lot of people don't realize is a Roth IRA by itself is not the investment. It's simply the account that you invest through. So you can still buy your favorite stocks or index funds through this account. A Roth IRA lets you invest up to $6,000 per year. And the great thing is, even though you're not allowed to take out any profit until you're the age of 59 and a half, you are allowed to take out any money that you invest if you need to. But I would recommend whatever you put in the Roth IRA, just to leave it there, because this money is going to compound over time, and it's the easiest way to retire a millionaire. With a Roth IRA, the earlier you can get started, the better, because compound interest really works its magic. Now, the second bonus tip that I want to say is, before you invest, even before you start a Roth IRA or a regular investment account, start an emergency fund. An emergency fund is 3 to 6 months worth of living expenses that you keep in cash in a savings account. A lot of people call an emergency fund a peace of mind account because it lets you have a cushion in case anything does pop up. You have to get new tires for your car, or you're out of work for a couple months. Having an emergency fund gives you peace of mind knowing that you'll be safe and protected if anything happens, and it allows you to invest anything extra into the stock market or into starting your own business without worrying if you'll be able to put food on the table, or without worrying if you'll have a place to live. If you're interested in getting started with investing, I'd recommend checking out the platform Webull. They're doing a promotion right now that if you sign up and deposit $100, they'll give you 3 free stocks valued up to $1,600. You can also grab an extra free stock by signing up for Robinhood, which is also a platform that I use. Make sure to subscribe if you haven't already. Thank you guys so much for watching, and I'll catch you guys next time. We're gonna be millionaires. We are gonna be millionaires. Guys, listen, we're gonna be millionaires. All you have to do is invest. Make your money work for you. That's all you have to do. That's all you have to do. Save your money, invest your money, put that money to work, make that money work for you while you sleep.